Well, hello and welcome to Trading Blows. Plenty to discuss in the show this week, including whether markets have become too aggressive in pricing in near-term rate cuts from G10 central banks. We'll also have a look at the prospects for China as the authorities there continue to throw ever-increasing amounts of stimulus at both the economy and the financial markets. We'll have a look at the equity market on Wall Street as stocks rise to new records and whether the rally there is looking sustainable. And I'll also give the gents a chance about 4 weeks into 2024 to see how their year-ahead outlooks may have changed since we last caught up at the end of last year. Without further ado, let's get on with the show. Right, well, let's bring the panelists into the show, as always, going head-to-head over 4 rounds, discussing a range of topics. No points this week. Last time I tried to use the system, it entirely broke my laptop, and we all know that Adam's going to win anyway, so it's a rather moot subject. Joining me, as always, this week, Ryan Paisey, the founder of PiQ Suite, also Richard Matthews, the head of FX and partnerships over at One.io in his corporate hoodie, and last but by no means least, Adam Linton, the head of the European desk over at Newsquawk. Without further ado, let's get on with the show. Right, Mr. Matthews, I'm going to start with you this week, mainly because we were having a similar conversation to this line last night. Markets are pricing a pretty aggressive pace of rate cuts from most G10 central banks still, well over 100 basis points from the Fed, the BoE and the ECB. What are your thoughts on this? Do you think markets are still far too aggressive and unrealistic in terms of what central banks are likely to deliver this year?
Yes, good. Is it going to be good morning or good afternoon by the time this is published? Good day to everyone. Generally, yes, I think they are much too optimistic. They've reined back their ideas somewhat, but I think there's so many worries out there geopolitically. I know that I'm going to be accused of being a warmonger, but I certainly think the Red Sea, which we'll come back to later on, no doubt, is a major worry. And I think there's signs that inflation is starting to perk back up again. I guess the next question is who's going to be the first one to cut and run. As we were talking last night, I think it'll be the ECB. I think they've probably got the biggest problems. But generally, I think the markets are reining back in, and I think they'll continue to rein back in. And I still think it's probably, in my book, even money that you get a hike from the Fed before you get a cut.
All right. Okay. Let's put this down something then. Let's quantify this. Even money, yeah? So will you take 50-50, will you take even odds that I back a cut before a hike?
Yeah.
We do 100 quid?
Yeah.
Done. Filled. Right.
On the Fed,
yeah. Done.
Well, there we go. 5 minutes into our first show of the year, and we're already opening a book on what's likely to happen this year. Dick, why do you think that? Because I mean, to say that's out of consensus is an understatement, I think.
Yeah. Because it winds Ryan up, and I look forward to settling the bet as we watch a certain person run round St James's Park in women's lingerie, winning another one of Ryan's bets. So this is one I'm happy to lose. I think that actually inflation isn't dead and buried. I think the central banks, and certainly probably the Fed, as we were talking last night, I was a bit surprised when people said that US exceptionalism is dead. I actually don't think it is. I don't think it's died at all. I think the US economy is still buzzing along really well. I think employment's looking good. I like the US, and I think there's signs that inflation's coming back. And I think the central banks are so scared, having let it go riot last time, that they'll on the side of caution. And anyway, and being an old broker, there's no point in agreeing with the consensus. You've got to say something outrageous to get people to talk to you. Certainly at my age, anyway.
Well, there we go. Dick's written our headlines for us. Ryan, seeing as you've taken on the other side of that bet, I mean, what are your thoughts? I would agree with Dick. I think that central banks are probably scarred by that whole transitory experience. But to say they're going to hike again, I just really can't see that. I think it's more a duration of where they are, isn't it?
So I'm only saying the Fed. I'm not saying other central banks. Check the tapes. He's definitely only saying the Fed. Look, I agree with my very dear friend, Mr. Matthews, in the sense of, first off, can I just apologise for what I'm wearing? I'm suffering from a bit of man flu, and I'm feeling
even by your standards, it's pretty. Yeah,
no, I have let the side down. I appreciate that. But anyway, so where was I? My dear friend Richard Matthews, I agree. US exceptionalism is alive and kicking. I don't think the Fed are like overly in a rush to cut rates. They certainly aren't going to be cutting rates for asset prices. When we're hitting our new high after new high. In regards to, but yeah, I disagree with him. Sorry, that they will. There's a good chance they'll hike before they cut. I think we'll just get a longer pause. As we all know, I love a good pushback story, and that's what we're seeing at the moment in the markets. So with ECB especially coming up tomorrow. So will this come out before or after the ECB meeting?
It should be before. It should be before.
It comes out, well, regardless, I guess it doesn't make any difference because I'm speaking way before. So it's all slightly irrelevant. But yeah, so I think tomorrow in particular, if we focus on tomorrow, hopefully, this comes out before. The name of the game will be how much pushback Lagarde gives in regards to, obviously the market's got a bit ahead of itself, but it has got ahead of itself, not just for the ECB, but for the BoE and for the Fed. What the market is crying out for rather, is some forward guidance. But we know that central banks of late, and can you really blame them, are very adverse to giving too much forward guidance because they've seen in the past over recent years that, fucking all goes to pot as soon as something big happens. So I don't expect the ECB to be offering us anything decent in that respect. They probably will lean onto the data dependency lines a few more times, but then that's what we can expect. Again, personally, I don't know why central banks should be cutting rates right now. If you're the ECB, or if you're in Europe even, yes, Germany and France are in the shit. But cutting rates by 25% this meeting or next meeting is not going to correct their problems. Their problems are far more systemic in nature. So the ECB, it's just not going to help. It's not going to turn the ship around, basically. In regards to the Fed, I think the Jan 31st meeting was showing like a 97% chance of unchanged, which is at 5.25 to 5.5, 5.25 to 5.5% target range. At one point we were like odds on, weren't we, for like a cut in Jan, or near enough. I think March is now.
I think it was March that the markets have been pricing mainly. I think Jan has always been kind of unchanged, but might tee it up for a March cut.
Yeah, sorry, you are right. March is now drifted off to a 50-50, right? So yeah, I think the market obviously got a bit ahead of itself, but then this is what we know, that these things they overextend when the market reprices, and then it's the central banker's job to kind of help with the mean reversion. And this is what we said just before Christmas, that if you think of a central banker's comments, basically most of their job is to issue mean reverting commentary because they don't want the market to get too far away from where it currently is. Just quickly, because I don't want to drag on, especially as there's no need, because there's no points being given. So one thing I think would be quite interesting, and again, this would be a really interesting binary bet if you could get this on with someone, is does the Bank of Japan hike before either the Fed, the Fed, the BoE, or the ECB cut? I think it's quite an interesting one. I'm due a couple of good questions. I think many market players expect negative cuts in place since 2016 to end this year, but obviously the timing is everything, right? The next meeting is the 18th, 19th. April's meeting is 25th, 26th. Something to be aware of. I thought this was quite interesting if you are looking at yen or Bank of Japan in general, is in Japan, the big firms have their annual kind of wage negotiations with the massive unions that basically run the employment sector over there. They have these every year, and they conclude mid-March. Now, Bank of Japan are no doubt waiting for the results of them before they determine exactly when they start hiking, if they start hiking, but I think they will. Which means that the March meeting is probably in play because the Bank of Japan's regional offices will have a guide of where these negotiations are going. However, Bank of Japan traditionally do not like making big policy changes outside of meetings that contain their quarterly outlook reports, which means that it brings the April 26th announcement is probably the one you want to be looking for. Now, so are we going to get a cut elsewhere before then? I doubt it. So I think if you could get that binary bet on somewhere, I would bet not the farm, but I'd have a punt on the Japan hike before anyone else cuts.
Yes, I think I would probably agree with that.
That's like an accumulator coming here, Ryan.
Well, if you want to do that, do you want to
you two can go and settle your bet somewhere else. I said it was a good question. It was also a good answer, and it was exactly the one that I was going to give. So well done there. Adam, let's bring you in from your cave. I mean, in terms of the ECB specifically, we've had pretty much everyone from the ECB who's spoken this year has pushed back on market expectations. I mean, the market doesn't really seem to have listened particularly much, though, does it?
Well, firstly, I'd like to give Ryan some pushback on saying I'm the one that takes ages to answer the question. That was a lovely seminar, Ryan.
We both know you like a bit of pushback.
Okay.
Please stop.
Right. I think I disagree with that about the market not really listening to the ECB. If you take, the time frame I've been kind of looking at when I was putting my preview together was kind of like the pre-December kind of time frame ahead of that meeting, because that's when we saw that particularly dovish inflation report. And then, so I think ahead of December, March was seen at 80%. That's now dropped down to 15%. And then year end is about 160 basis points, and now it's about 130-ish. And we've now seen April, that's no longer fully priced. The first fully priced meeting is June. I think April is still about 80%, so there's still a good chance. So I think, the ECB have actually done a relatively good job of pushing back, because one of the things that surprised me is the unanimity in which they have been doing that. Obviously you've seen some really out of consensus hawkish comments from the likes of Holzman, who said we may not even get a rate cut this year. I'm pretty confident we will get one. But ultimately, as the case of the FOMC, the BoE, they can't really forecast that much meeting to meeting. They're waiting for the data that will play out in March and April. And until then, it's just almost a bit of a waiting game, and they're just kind of treading for water until then. I think, just picking on what Ryan said about, the kind of pushback we'll get for the ECB. I think one of the comments that you'll see, I think sort of from like Lagarde and Schnabel, is they're just basically making the point to markets. If you ease financial conditions, you're doing a lot of the heavy work for us. And so I think that's kind of the way things will go for the ECB. And it's just a case of waiting for data. Lane, he said in the FT, was it week before last, that by the time of the June meeting, they'll have the data they need, and then they can go from there.
Yes, it was interesting to hear Lane say that, particularly as he is generally perceived as one of the more dovish members on the governing council and the exec board, and also when he's very much perceived as sort of the brains of the operation. You've then got to almost assume that everyone will eventually end up coming round to his view, which would mean that, of course, Ryan's bet that the BOJ hike before others end up cutting is probably more likely than not. In any case, let's move on. Because
can I just quickly flag something, because I think it's probably worth talking about. Obviously, we had on Monday, I think it was Monday or Tuesday, the survey of the ECB, actual people that work in the ECB, basically saying what we all know.
I know where you're going with this.
But Lagarde's lost the dressing room. People in the ECB actually don't think she's doing a good job. They think the ECB's working for her rather than her working for the ECB. So I'm not saying this is going to happen, but it's good to think about, extreme kind of situations. Do we think that within the next 6 months there's any chance at all that we could have a proper unraveling of the ECB and Lagarde gets booted out before her term ends?
I think she'll do everything she can to cling on to power, because she wants the victory lap to say that she's crushed inflation.
Exactly that. And also the other thing is, I don't think Big Sam is ready for another job yet.
Valid point. Moving on.
When he is, I think she's out. But for now, with Sam Allardyce on the sidelines, I think she should be fine. Right, let's get on to China. Actually, speaking of Sam Allardyce, I'm surprised he hasn't taken a job in China at this point. He's been out of work for so long. Anyway, what is going on with China? Ryan, why don't we start with you here? You've drawn the proverbial short straw. The equity market in China, and for all intents and purposes, we may as well lump Hong Kong in with this as well, has been, notching 2, 3, 4% declines a day. The A50 is at its lowest level since 2019. The government seemed to be throwing more and more stimulus at the problem, but nothing seems to be arresting the slide at the moment. So I guess the question is, what gives?
Well, thanks for throwing me in at the deep end.
No, this is a forfeit for turning up like that.
To be honest, I'm very, it's valid. I
reckon this answer will be a bit shorter than the last one.
Don't poke it. You're right. Obviously, one of the stories of the year, or the last, God knows how many, 18 months, is the slow demise of the China stock markets and the economy in general. Obviously, we can't believe what's going on based on what the official data is. One thing that does irk me a little bit is some people try and be clever, sort of Jim Bianco, for instance, saying, "Oh, it's not being picked up in Western media." I don't know what he's reading, but it's been picked up plenty in the financial press I've read about the demise of China, especially if you've been clinging onto the news via PiQ. But yeah, anyway, so forgetting that bit, it's clear that China's in a far worse position than the fake data shows, compounded by the fact that China is intrinsically a difficult place to invest because no fucker knows what the ruling party, the policymakers are going to do next. There's whole, research houses out there and consultancies that charge fortunes for Chinese insight, and they're getting it wrong as much as anyone else. No one knows what's coming next. However, we do seem to have found a bit of a pain point for the Politburo in kinds of levels we're at. There's been talk of the stock market hitting these levels where these snowball derivatives are getting knocked in, which basically will increase the problem, because as these structured products are getting stopped out, it means that there's a lot of selling that has to go on against them, which is kind of snowballing the impact. So I think that kind of why we've had over the past 48 hours a load of new measures coming out. I think it's probably related. If you think about it, we've had more in the past week or so, the past 48 hours, we've had more rulings against short selling. We've had the mobilization of 279 billion to form a fund that will go directly into buying stocks. They're not even mincing their words anymore. They've actually said, look, we're going to get this money and we're going to buy stocks with it. And we had this morning news that China will cut its reserve requirement ratio by 50 basis points, which is the biggest in 2 years. That basically is the amount of capital that banks have to hold in regards to the reserves in their banks, basically. It's kind of a buffer so that if a load of people go to the bank and say, look, I want me money, they've got some money in there to give out. Now that measure, this cutting the triple R, is always, if you ever hear of anyone talking about the triple R rate, it's a reserve requirement ratio. By cutting it by 50 basis points, it's estimated that it will free up about $140 billion. The idea being that 140 billion will go into stocks. No, not necessarily it will do, but you can bet the farm that the governing body, the Politburo, the policymakers will be leaning on every bank, saying that rate, that dollars that we've just freed up for you, you must go into supporting the stock market. That's why they've done it. That's why they always do it. If you add into the mix that there's been a load of capitulation in Chinese stocks recently, we've had the big news about this giant Chinese hedge fund that's kind of over leveraged and trade on tilt, trying to buy the low in China and then went bust. This is kind of all evidence of the flush that people talk about. Before we have a big rollover, before we have a big turn happening in direction, a turnaround, we always seem to get big flush events. Now, for me, I'm seeing a lot of evidence that we're hitting these flush events in China at the moment. So you could say, is the turnaround happening now, or it's about to, or is it just happened? I think it's one of those. I think we're very much in that area where the turnaround is happening. But I'm not going to kid myself. This is a punt. But getting long Chinese equities right now is a punt that I believe the risk reward is on side to make that punt happen.
Well, I'm very glad that I started with a P and not something else. But Adam, I'm afraid you were wrong. I think that answer was almost as long as what he was saying in the first question. So let's bring you in, mate. I mean, obviously, we had that triple R cut this morning, which just allow me to have a moan at the second. Whoever is writing China headlines at Bloomberg, sort it out. They made a right pig's ear of that one earlier on. But in any case, I mean, do you think that we're just going to see more and more of this stimulus until eventually the market begins to recover?
I think the thing with China is it just seems a lot of time it's just a walking contradiction. It kind of has these kind of long-term kind of economic goals to kind of boost the consumer, sort out the property sector, sort out financial excess. But I think the bigger problem for China is, if you go back to last year, the big kind of economic optimism story was we're going to have this Chinese reopening effort and it's going to lead to an economic boom. And it just simply hasn't happened in any shape or form and just isn't happening. So I think, as that's gone on, the market's just grown more and more skeptical over kind of what's going on in China. And, they're tinkering around the edges and stuff, but ultimately the property sector is in the doldrums. They need to kind of fix that out. They're trying to boost, do something to become a more consumer orientated economy. But all the things they're kind of doing are just tinkering around the edges. I think what the market really needs to see is there's signs of an actual sustained economic rebound. And I think when you kind of look into it, I think it's a bit more difficult to see how that happens, because obviously China's a huge trade export market, but we're going into what could potentially be more of a slower growth environment, particularly from the US, from the Eurozone and elsewhere. So for they need to focus domestically, and I don't think they're really kind of like pulling any policy levers which are kind of really adhering to that. I think the market thinks back to the earlier 2000s when they could just have the big policy bazooka. Well, they don't want to do that because they want to curb financial excess. I think they're kind of stuck in a bind, and they might ultimately just be needing to wait for kind of broader market forces to help them out. But from a geopolitical perspective as well, it's election year in the US. The one thing that both parties agree on is taking a tough stance from China. And the longer terms for China is people wanting to remove their production out of there, and then the regulatory environment just doesn't even begin to help any sector. So, you take the tech sector, as soon as it starts growing, they'll automatically just clip its wings. The market will sell off, and they'll try to do something to kind of undo the damage, but it'll just never kind of be enough. So I think a lot of people are just thinking it's kind of uninvestable at the moment because, yes, the stock market is, the industries and the way they regulate them are incredibly tough. But if you're not getting the economic growth to compensate for that, then, what's the point?
Yeah, I think you're absolutely right. I think that uninvestable view is very, very much becoming consensus on the buy side at this point. And also, walking contradiction, I think that sums it up incredibly well. In terms
Did anyone think of like walking like an Egyptian when he said that? Walking.
No.
There was an author's piece actually, and he was kind of making the point that is India going to be kind of be seen as like the big EM kind of play that China was, over the past decade? That could definitely be one to watch.
Didn't their stock market just exceed the value of China's? India's.
Yeah, I think that was that head. I think a headline hit yesterday, and then the Hang Seng soared into the close, and they did something. So I don't know if it's one of those things. It's kind of like they're kind of like oscillating now, but it's near enough.
Yeah, it's like when sorry, Ryan, I was going to say it's like when the Paris market overtook London, and the FT started popping champagne for about half an hour.
The Chinese government hate the Indian government. There's always a bit of ruckus along the Himalayas and whatever. So you wouldn't put it past the Chinese sticking all this stimulus in because they don't want that headline in. This is what I mean. It's intrinsically a horrible place to invest because you just don't know what they're thinking.
Yeah. Anyway, Well, I was going to say, speaking of ruckus, I'm sure that, geopolitics and war and God knows what other bad news features in Dick's outlook for China for the rest of the year.
Actually, I've got very little to add to either Ryan or Adam's comments, apart really from what Nick Jovanovic said, who I got a huge amount of time for, was one of the brighter lights on Twitter. He said, how can you ever trust the communists when they're talking about prices? And the bottom line is none of us have got a clue what's going on in China at all. And I suspect it's probably worse than we're seeing. I think Evergrande, the property empire, which has completely collapsed. I see the bonds are being challenged offshore. So I think actually it's getting worse and worse and worse there. And funnily enough, I do think it will have an impact on what China does in Taiwan, because a good war will deflect an unhappy populace from anything else, and a good war to get Taiwan back in the fold will not only occupy lots of people, keep lots of soldiers happy, but also potentially boost the economy. Whilst the West is looking the other way, the West is preoccupied with Ukraine and Iran. And, I'm not going to beat around the bush. I think whatever is happening in Israel is Iran behind it. So I think Iran, and with the Houthis, Iran's behind it. So I think there's plenty to occupy the West. As we say, there's an election coming up. Biden's being kind is sidetracked by the election. So I think Taiwan might play into this, and you could see China really get quite aggressive over it.
Yeah, so sadly, I do agree with you on that. Not sadly, I agree, but from a sort of humanitarian perspective, if you do look at what's going on geopolitically, there are a lot of distractions for Western nations. There's a lot of uncertainty. I mean, we've all seen those headlines that 40-odd% of the world's population are going to be going to the ballot box this year. If you were a slightly nefarious state actor and wanted to cause a bit of trouble, now is probably the best chance you're going to get in a long time to actually do that, you would imagine.
Especially if you're watching this video, having read in the newspaper headlines today that we would have to call up the general public to fight on our behalf. Anyone watching this, hopefully I'm too old for it, but anyone watching this would go, oh my God, I'm in there.
I was going to say,
sorry, as long as 650 MPs are in front of me, I'll be first in the queue.
Well, you look like you're dressed and ready to go, Ryan, actually.
well, what I was going to say was, unless they fancy a remake of Dad's Army or cripples are allowed on the front line all of a sudden, then that counts Dick and I out.
No, I think Ryan would be in the special needs, not special forces.
Oh, no. Move on. Right, let's get on to US equities. Right, well, let's get on to the US equity market, because over on Wall Street, stocks and major indices continue to print new all-time highs. While Ryan has a little bit nap there, we'll start with you, Adam. The S&P 500 and the NASDAQ, 3 straight record highs at the time of recording, could be a fourth looking at where futures trade at the moment. The Dow closing north of 38,000 as well. What are the risks facing the market at this point?
We're quoting the Dow now, are we?
I'm quoting the Dow because I am under orders to quote the Dow. It is not because I want to. It is a stupid, horrible, old-fashioned index that's badly calculated and should have been retired about 4 decades ago.
That's like me.
Like Dickens.
Like going there first.
I'm under duress. Send help.
Yeah. So in terms of, kind of the drivers of the rally that we've seen, I think, it's kind of like a 3-pronged thing whereby, the trend of disinflation as it's taking hold is giving people a lot more optimism about, the global rate cutting cycle, which expectations, yes, they've come in a little bit, but still relatively dovish. And then I think you've seen the low expectations for earnings, as you often see ahead of earnings season. Earnings estimates gets lowered and then they beat them and things look a lot better than they actually are. I think, though, in terms of kind of pixel time as to where we're currently at in the market, I think...
Whoa. Sorry, hang on a minute. What pixel time?
Oh, mate, I'm glad you picked up on this, because I picked up on this many months ago. Pixel time.
This is something... It's sent off court of Yogesh. Blame Yogesh Chandarana.
What is pixel time?
Pixel time?
I don't know. It's at this moment in time.
For those of us who speak English, I think he means at the time of recording.
Oh,
yes.
Okay.
It's embarrassing.
Yeah, now.
So I kind of think ultimately at the moment, though, I think, this trend of disinflation is a relatively well-carved path now. And I think, if anything, risks lie potentially onto the upside. And therefore, I don't think you're going to see any immediate further reprieve on yields until the Fed actually start cutting rates. I think earnings, they're holding up well for now, but in a disinflationary environment, companies' pricing power is going to be on the declines. I think, see how some of the real economy stocks do in the progressing quarters, whether they can hold on to that pricing power, whether, it hits their margins, then begins to act as more of a headwind for the stock market than it does now. I think that would be something to watch. And ultimately as well, we are expecting a slowdown in the real economy. But as we've always said, you take some of the S&P 500, all of that is just completely irrelevant, because it's just 7 companies which are just driving all the gains in a market cap based index. And as long as they can hold on to their gains, all of the broader macro trends just seem to be completely irrelevant. AI is it still remains incredibly thematic. Any developments on there are always richly rewarded. And then the big tech companies, they always seem to be able to cut 10,000 jobs out of nowhere, and then just keep on marching higher. So I think, there are reasons why we could consolidate, but I just don't think there's really going to be anything that's going to really slow down or lead to reversal in what we've kind of seen from the S&P 500 over the past quarter or so. And then when the Fed starts cutting, we may even see like a further ramp up more towards the second half of the year. That's kind of how I'm looking at things at the moment.
No, I think that's a good framework to look at things. And I just want to pick up on your last point, Ryan. Let's bring you in. Do you think that the reason for the Fed cutting will have a big impact on whether or not that is bullish for the equity market? And what I mean is, if the Fed are in a situation where they're cutting, relatively gradually just to try and ensure that a soft landing is actually going to take place, is that different than a situation for equities in particular? Is that different from a situation where the Fed are having to cut aggressively because growth has almost just hit a brick wall?
I think the action of a cut regardless is always going to be seen as bullish for stocks. I don't think it matters why the cuts happened. Obviously, if they are cutting because of multiple catalysts and shit hitting the fan, and they're cutting aggressively, stocks will already be lower at that point because we've already had that shit that's hit the fan before they've cut. But when they do cut, it'll be a boost to stocks. Same as if we're going sideways or small or grinding higher and they still decide to cut, then it'll be another bid. I don't think the market really cares so much when that announcement happens. Why? All they care about is has it happened, yes or no. I think I would put it this way: I wouldn't short equities at the moment with stolen cash. Just makes no sense. We always say look at the path of least resistance, and that path remains definitely higher. If we had no news, absolutely no news, what do you think is happening? We're going to just drift higher. I think if you're looking for downside in equities, you're looking for very large and continuous waves of damaging catalysts that's going to turn the boat around. And to be honest, I don't see it. And I don't even if we do get this big old war in the Middle East or whatever, I honestly don't think that's going to, it might be a hiccup. I don't see that turning equities around. The world still grinds on if there's a war in one part of it. I think God knows how many shows we've done. I've been bullish equities. Thankfully, it's paying off. Yes, I'm not saying it's, it makes sense. But my job isn't to say whether the markets make sense. My job is just basically look at markets and think, how do I think which way is it going next? And I think it's crucial that you differ, especially as a trader, especially as a new trader, a retail trader. What you think makes sense, no one gives a fuck. It's just all the market cares about is where the bids and offers coming from. You might think something is going the wrong way for the wrong reason, or going a way for the wrong reason. But if it's going that way, the market is right. And if you're going to just keep fading against it because you think the market's wrong and you're right, you will do your account, and you will do multiple accounts if that's your mindset. So, look, I don't know why. I can't see. It makes no sense to me. Sorry, why it keeps screaming higher. But at the same time, I'd be buying dips at any opportunity.
Yeah, I would strongly agree with that. And I think that's very, very important and sage advice that, you need to analyze and trade and view what the market is doing, not what you think it should be doing. And I think the same actually goes for central banks and monetary policy. I think there's a lot of central banks should do X, not necessarily central banks will do X. And you can't trade on what they should do.
You see it on social media and all that time. Some very wise heads, and we've seen it a lot recently. Some very, very wise heads, and we're talking like market veterans, have got themselves in a corner where they've screamed that stocks are going to turn around, they're going to start selling off. They haven't. Rather than just say, all right, fair cop, gov, I've got it wrong. This market's crazy. It's still going up. And the market can be crazy and you can be wrong, right? Instead of doing that, they're backing themselves into a corner further and further. And they're now screaming that the market's wrong. Everyone else is stupid. They're the only intelligent ones in the room. And yet they're doing their absolute balls.
Yes.
So Look, I'd rather be stupid and making money than intelligent and doing my arse. And thankfully, it turns out it is the former at the moment.
Oh, damn, you beat me to it. Well, we do have our own market veteran here, Mr. Matthews. The S&P 500, as I speak, trading 4,900. What do you think we see next? 4,700 or 5,100? So 200 points, given all that's coming up over the next couple of weeks. We've got the Fed next week, the quarterly refunding announcements coming up. Big tech earnings season is going to start coming around. Are you as bullish as myself and Ryan?
I am actually. So I think you'll see 5,100.
Sell.
Yeah, that's the top.
If all three of us are in agreement,
I think you'll see hiccups. I think the quarterly refunding announcement might be a bit of a hiccup. I think the Fed, Powell's going to come out punching. I think he's probably disappointed by the reaction to his last press conference. So I think the Fed will come out punching, and he might see opportunities just to buy as it dips down. The QRA, I think, might be surprising to people. And then we're starting to get into the election run in the States. The way it looks to me, Trump's going to walk this. And Trump will be good for the stock market, and he'll be good for a broader section of the stock market than we've seen. I think that you'll see the old industrials and the old-fashioned industries being helped by Trump. And sadly, it's a dreadful thing to say. If we do actually end up having more and more of a war, that's good for industry, because you've got to build planes, you've got to make armaments, etc., etc. I can't even say it, but you know what I mean. So I think generally the stock market in the States looks good. Can I just
interrupt there? Something you've just mentioned there, and I think it's something that I'd not thought about before, but I heard it yesterday, and you've kind of hit exactly the same nail on the head. So we talk about the demand. So just speaking about copper, for instance, just quickly. Everyone talks about the green revolution being beneficial to copper prices. Now, copper is very, very, very important to the arms industry, ammunition and stuff like that. And so someone very important yesterday made a very good comment, similar to what Dickie just made. War is very good for commodity prices, not just in terms of driving them up because it's harder to get hold of them, but in terms of they use a lot of commodities.
Yeah, and it's a horrid thing to make money off the back of war, and I would never suggest that anyone did, but I think that generally that could support the stock market. The only worries I have, the only thing which I could see really hitting the market hard, as unpredictable weather occurrences which are hitting commodity prices, which I touched on time and time again. Certainly, the weather is, as we all know from the weekend and last night, very, very lively over here. There's been a really cold winter in the States. Rice has been hit hard in India. So I just wait a little bit, inflation comes back in. But all that does is delay rate cuts, despite the next hike that we're going to see in the States. So I just slip that in there. All that does is really delay the inevitable. So, yeah, I mean, really hard to go shoulder the market.
Yeah, I would absolutely agree with that. I just wanted to make one final point on that before we move on, just because I've mainly for the benefit of our viewers, because I've seen a lot of confusion about the quarterly refunding announcement. It does come in two parts, which is seemingly what confuses people. You get next Monday, so the 29th, we get the total issuance that Treasury are going to be issuing. And then on the Wednesday, we get the breakdown of how that is split between bonds and bills and all the various maturities and all the rest of it. So there are kind of two events associated with that. And arguably, the one that will have the bigger impact on the bond market is the Wednesday rather than the Monday. But important to keep an eye on both, just to clarify that one. I think Wednesday is going to be a busy day because, of course, we've got the first Fed meeting of the year as well. In any case, let's get on to our final topic and look ahead to the remainder of 2024. So we sit here on, the 24th of January. The vast majority of the sell side consensus has been pretty much torn up already. Certainly that bullish China view that everyone had, as is often the way. I think when we sat here towards the tail end of last year in our final few shows, we were all talking about 2024 being, the year of a soft landing. Inflation risks are still there, and policy divergence being perhaps one of the standout themes. Adam, let's start with you. I mean, what do you think are the big themes that are going to drive markets, or even the risks that may face markets over the next, 11 months or so? And of course, we're not going to hold you to it if something pops up as soon as we turn the cameras off.
Yeah, I think you, in some of the questions over, you referenced it with the content of the last trading blows before Christmas. I wasn't on that show, and I've got to confess I haven't watched it back. But I'm gonna
such a loyal participant in this endeavour that we're doing, aren't you?
I know, terrible me. I think obviously we are very early into the year. I think, for the soft landing thesis, which, a lot of people have been proponents of, I think, that's very much in play at the moment. There's been nothing really to dissuade from that view. I think, inflation's falling, labour market's holding up particularly well, and growth is slowing. But, if you look at the Eurozone and the UK, if we get a recession, it's going to be the mildest of mild recessions anyway. So I think, ultimately we are kind of on track for that, but it is early days. I think one thing that kind of concerns me a little bit is just how linear expectations are for these global cutting cycles. I think, it was relatively linear on the way up. I don't think that's necessarily going to be the case on the way down. I think people just see it as too clean a path. I think, normally the Fed hikes until something breaks. And yes, we had the banking crisis last year. But, as the impact of the rate hikes they've already delivered kind of filters through to the economy more, people have to refinance at higher rates. We may see something more aggressive than that's potentially priced in by the market, or growth may slow to a greater extent than is currently expected. But it's kind of hard to call surprises at the moment. I think one thing I tweeted you about the other day, and this follows on for your point of, is it 40% of the world's population are going to be subject to elections this year? Well, what do you do before elections? You have loads of giveaways. That's the fiscal side of the equation. So if the fiscal side is more looser than people think, then the monetary policy side therefore has to be tighter. I think the UK is a really good example of this, and potentially one to look at. So we'll have our March budget, but then they're also looking at potentially doing another fiscal event ahead of November election, and then potentially another announcement in between then as well. I think it was in the Times a couple of weeks ago. So clearly, I think this is definitely an underappreciated risk that I don't think the market's necessarily priced in. But from a monetary policy stance, you've got to remember as well, though, that expectations of fiscal easing, monetary policy can't do anything about it. To the Bank of England, they can't try and second guess what the government's going to do. They can only wait until the policy is formally being announced and acted upon. So you could potentially have competing forces in the UK of both fiscal and monetary trying to loosen at the same time and then get slightly out of sync with each other. I think, the geopolitics stuff, I feel like a lot of it is just always kind of just noise, a lot more noise. Yes, it's important in the news, but financial markets, I just don't think it's really driving anything at all at the moment. I think, Ukraine is very much as you were. Israel, they're talking about potential ceasefire hostage releases, but there's still been no broader proxy war that's really kind of materially escalated. There's been some of the stuff in the Red Sea, and yes, it has potential to drive inflation higher, but central bankers haven't even begun to sound the alarm. I think, China and US, that's potentially one to watch. Obviously, it is election year, but I don't think there's really too much at the moment. But as you always say, when we sit down in December, the big risk or potential fear factor of the market is something which we won't even be remotely on our radars at the moment.
Absolutely. That is always the way. I must admit, when you said a reply to one of my tweets, I thought it might have been what you calling me out on one of the various puns I've made over the recent weeks, rather than something that was actually informative. And I think it is a very good point that, you are going to end up with governments trying to give away as much as they can to get some votes, and central banks are likely to end up being worried about that. And Dick, I wonder if that speaks to your long-standing worry about inflation making a resurgence. Obviously, services inflation is still pretty sticky. Goods inflation starting to turn around. Is looser fiscal policy then the spark that really kicks that off potentially?
That could well be the case. I think, just going back to the overall question, I think it's the year of policy divergence, and we're going to have US exceptionalism, and then we've got the UK and the ECB just concentrating on the three of them. The UK, we're obviously going to have an election this year. I suspect it might be earlier than Sunak wants. I think he's painted himself into a corner, certainly after last night. A few warning signs were warning noises were being made. And if you're an MP, actually, why do you want to hang around for another 9 months, or Tory MP, another 9 months or so, knowing that you're going to lose your seat? Get out now. Get
90 grand a year salary probably helps.
Well, yeah, I think that they're looking to the future. Get out now, get a new job, and get on with it. So I think they might push an election quicker than people expect. Either way, Hunt's going to open his checkbook, dish out money in March, April, etc., etc., etc. Whether the Bank of England's aware of that, I don't know. Whether they're aware where they actually work is open to the question sometimes. Actually, not to cast that aside, they must be aware that there's a very good chance that fiscal policy will be loosened and there's going to be a giveaway. And I think that is another good reason that they will delay cutting rates. I think in the States, it's going to be really, really interesting because to me, as I said earlier, Trump looks absolutely nailed on. But then Yellen and the QRA and how she paces the timing of that's going to be really, really interesting. And again, if you give money away, it is inflationary, the bottom line of it. So that's the one thing that I'd be looking out for. I actually disagree with Adam. I think that the situation in Israel, I think it's going to get well, in Gaza and Israel is going to get worse. I fear that there's not many of those sausages left alive, and Israel will carry on and they will wipe Hamas out, and Iran won't be able to back down. And that's my one fear. And it's been coming for years, this confrontation with Iran. And personally, the sooner it gets out in the open and gets done, the better. So I'm a bit doom and gloomy, I'm afraid.
Well, there's no change there.
No.
I just want to pick up on a point you did make, and Ryan, I'm keen to get your views on this, because I think there's just this kind of blurring of monetary and fiscal and political issues all coming into one. Is that, we're talking about this is going to be the year where rates are reduced, where rate cuts are delivered by most G10 central banks outside of Japan. We're also talking about this being the year where fiscal policy is likely to be loosened as we move into these elections. But to what extent do you think the timing of these elections, if at all, is feeding into what central bankers are thinking in terms of when they cut rates and trying not to look as if they're being political when they're reducing their overnight interest rates? That's a nice, easy question for you to end on, isn't it?
Just as I'm coming off a Lemsip high as well, so yeah, thanks for that. I would just
like a postgrad dissertation question. I think that's it.
Where's my bottle of Calpol when I need it? Well, one thing I will say is that I believe it was the last show I did, which was December 13th. I flagged that loosening fiscal policy, or loads of fiscal policies will be coming into effect this year. So I'm glad to see my dear friend Adam bringing that up and saying that could also be something that's coming. So nice to know that I'm a month early. Stop it. But yeah, so in terms of that, as I said last time, I think there's going to be a load of stuff thrown at voters to get them on side by the ruling parties. What impact will the election cycles have on central banks, which is kind of what your question is really. I've got a very long-winded way of saying it, but I think personally, if I was the Fed, although they're completely meant to be absolutely, unrelated to political sides of things, they're completely, unaffected by all of that crap. We all know that's not how the public perceive them, and also how sometimes it just doesn't naturally work. So if I was the Fed, I would be wanting to get me cuts out, at least a couple of cuts out before this happens, so that then, because what they don't want to see is Trump gets in and then they cut rates, because then that'll look really bad. Don't get me wrong, stocks will love it because it'll be stocks up because of Trump, stocks up because of rate cut. So if you're bullish stocks, that's the combination you want. But yeah, I don't think they'll like to be seen as cutting rates, or even, as Dickie says, I might be wrong, it's hiking rates based on the winner of the election. So for that reason, I think they would like to be at least one or two cuts in, or hikes, or whatever you want to do, before the election results come in. Like I say, I could be completely wrong and try.
I think I agree with that, because if you're Powell and you start cutting just before the election to give the economy a boost, if Trump wins, he's going to fire you straight away.
See, this is the thing though. If he cuts rates, because Trump wants low rates, so if he cuts rates just before that, if Powell cuts rates, stocks rally, and then Trump still gets in, Trump's going to say straight away that stock markets have rallied because they knew he was going to win, because he was odds-on favourite. And he can thank Powell, because Powell's calls this. And
in the run-up to the election, though, he'll say it's political engineering.
Even though Powell is a Republican.
That's why he's got to get out of the way nice and early, if he's going to do it.
That's what I'm saying, I'm agreeing.
Yeah, I think the general... I was going to say, I think the general takeaway is, if a central bank is already in its easing cycle, it's going to be a lot easier for it to carry on doing that, no matter what the politicians are messing around with, rather than...
As long as he's cutting and not hiking, there's no way Trump's going to turn around straight away and go, oh, you're fired. Because the guy's been cutting rates, which is good for the economy, which is going to be good for the first 100 days of his election. And, everyone loves talking about, I've watched enough West Wing episodes to know that the first 100 days is quite important. So yeah, I disagree. I'm glad Adam agrees with me about they've got to be into a cycle already, but I disagree with Adam that Trump's going to turn around and sack Powell because he's.
Does anyone see Biden winning?
No. I'm not completely sure he faces Trump.
Does he know what day the election is?
I
think Trump's actually been. If you look at a lot of things he said, I think he's actually changed his tone quite a lot. He's trying to be less divisive. He's calling for kind of unity with American voters. He's more, he wasn't with Nikki Haley last night, but with DeSantis, he was a lot more kind of gracious. I think he's trying to really mop up that centre ground and kind of distance himself from the January 6th kind of us versus them mentality. I think, it's his to lose at the moment.
Yes.
Problem is, but then obviously we got discussion where it's like, is he only saying this to try and quell the legal aspects that are coming into attack? Because basically the only way, by the looks of things, the only way he doesn't get the GOP nomination is if there's a legal reason why he shouldn't get the nomination.
Well, he benefits in polling when they throw these cases in. People are feared he's going to turn Americans a banana republic.
But what I mean is, in terms of there might, what I'm trying to say is, if he was really aggressive and really kicking off and really going after the Jan riots and all this stuff, there could be, I'm not saying there will be, but I'm just looking at kind of future proofing it. There could be reasons legally wise where he can't be the nomination, right? Forgetting what polling's saying. I'm saying that they actually say, look, GOP say actually we can't because there's a risk that he's going to get indicted as soon as he's in the office, right? That's why, in my opinion, he's playing it safe now, because he's given himself the best chance that he makes it to the ballot day without being in the shit legally. What that doesn't mean is, though, if he does face Biden, he wins, right? It's pretty much nailed on. He beats Biden, in my opinion. If he then wins and becomes president, just because he was quite centre ground or increasingly centre ground before he got elected, doesn't mean he's going to be that after he's going to be elected. We could see two sides to Trump: pre-election, post-election, and post-election.
But he could pardon himself as well.
Well, indeed. I mean, I think we're going to have plenty of time to talk US politics and Trump over the next 10 months. And I'm sure by the end of that 10 months, we will all be incredibly bored of it. Of course, we've got a UK election in the mix as well to keep us entertained, in addition to what's going on stateside. But in any case, we will wrap up the show there for this week. Thank you very much to the gents for joining me. Ryan Paisey from PiQ Suite, Dick Matthews from One.io in his branded hoodie, and last but by no means least, Adam Linton over at Newsquawk. Thank you also to our producer Kyriakos as well for bringing this together as brilliantly as always. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know your thoughts on anything the chaps have discussed or on Ryan's weird outfit today, and we'll be back with another show in a week's time. Thanks as always, and goodbye for now.
Bye.
Cheers. Bye-bye.
Bye.